this now. Shankar, are we reaching that point of maximum pessimism now?
So there is a lot of pessimism. There is also a lot of maximum pessimism across, if you talk individual investors, small investors, because the US has not been comforting. Usually, when India has had a bear market in the last, let's say, 10 years, something has been there which at least has given some degree of solidity, and it has been usually the US market because of the FANG stocks over the last 10 years. They have provided some degree of hope that there is still a bull market on somewhere, and hopefully India will correct and then go back up. This time, for whatever it is worth, I mean, the US end has been absolutely ugly. And while we sit in India and we worry about us Indians and the Indian stock market, I think most people, including me, are thankful that we don't have a lot of FANG stocks in our portfolios. We do have, I mean, I have a bit, but not a lot. And I'm sure as a percentage of Indian household savings, I don't think a lot is in the FANG stocks or in US tech, because that part has been absolutely ugly. So in bad times, Nikunj, the only way you can deal with a bad situation is when you look at even worse situations. Okay. So let's say you have a headache and then you go and see somebody who had a brain stroke, and you will say that my migraine is nothing compared to this guy's brain problems. You see, when you have an ankle sprain and then you find a guy who has fractured a knee or something, or a shin bone, you will feel much better because you say it could have been worse. So in situations like this, instead of feeling sorry for ourselves, we should look outside and see, guess what? The world is even uglier than what we see in India. And you will be able to deal with problems only when you have a wider perspective of how bad things are.
Fair point. But in both the instances, you do need a medical help. You need an expert advice to understand that how can you deal with the collateral damage. So what is the best way to deal with collateral damage? Sit on cash, this market will get better entry points, or start putting money to work, whatever is left, because this is more like an Amazon sale, not the stock market sale. Like a proper Amazon stock market sale.
Right. And I think Amazon Prime Day is also coming very, very soon. So now here is the thing, that in situations like this, the way to play this is very simple. Uh, you have to buy strength. You cannot buy weakness. Or let me clarify. For 100% of your portfolio, of that 80% should be reshuffled into stocks and groups which are exhibiting strength. And only 20% should be in stocks which have really crashed a lot, but you do believe, due to whatever might be your fundamental reasons, that they represent good value. The typical mistake that all of us make, seasoned or unseasoned investors, is we do the opposite, in which we keep our losers and we sell our winners. And that is usually a recipe for disaster, because when markets recover, and they will, okay, it's inevitable. It might take a few months to recover, but markets will recover. At that point is really the strength group which would have actually delivered you positive returns even in a bear market, while the weakness group will remain down and probably might even go lower. And I'll give you a recent example from my own portfolio, when uh, a certain stock called Peloton in the US, in which, not because I had bought the stock, but I had written puts on it. The price was, I think, 150 when I wrote a put for $60. $60, imagine, okay? And guess what? It got exercised because the price fell to $40, $45 at the expiry, which was like a 6-8 months out option. And it was inconceivable a stock as storied as Peloton could fall so much. Now, here is the thing, that what are you supposed to do then? What am I supposed to do as an investor is that this stock should not have fallen so much. Now, I'm unfortunately long this stock at $60. I have to sell. There is no point in waiting for it to recover back to go beyond 60, which is my purchase price. The mistake we all make is that we hang on to such losers. Today, Peloton, yesterday was $11. Okay. So that tells you, buy the strength part of the market. And normal screeners, if you run in the market, will tell you enough about what groups are holding up well in this carnage. Buy those, and only 20% should go into the really 90% down stocks or 95% down stocks if you believe that fundamentally they don't deserve to be there.
My next follow-up question is that should one trade and invest at all? Because it's a nightmarish scenario given the market volatility we are in. And if valuations are not that attractive based on historical benchmark, then markets can certainly unwind a bit more.
Yeah, always can, Nikunj. And, I'll give you again a personal example that throughout the 90s, and in fact, for a few years, even after that, after the tech bear market of 2000, obviously I'm in the stock market. A lot of my friends or even my relatives would keep asking me that, should we go in and invest in the stock market and all that? And I told them that, look, this is no place for your money, or at least the bulk of your money, because it's a highly volatile form of returns, unlike rental income or fixed deposit income. And I would tell them that please buy invest in fixed deposits or good corporate deposits which are unsecured, but still good names will give you your money back, because you were getting 8%, 9%, 10% numbers, even 12% at some points in the 90s. And relative to the equities were never, ever attractive. And that's why we see 90s was the lost decade for Indian stock markets. We delivered nothing in aggregate return terms. There was the IT pack that did well, but that was the exception. Then the equity story came because of the collapse in interest rates globally and in India after the tech bust, when rates were cut aggressively by all bankers. And that's when the equity markets came back into their own, and returns have been fairly decent in the last 10, 15 years. Now that rate cycle again has started to worsen. When you look at markets, it comes down to very simple things: the direction of the US dollar and the direction of interest rates. If you simplify things down, at this point in time, most investors will feel that equity investing is simply not rewarding enough. And I can appreciate that point of view, because it is not an easy way to make money. Your 15% compounding over 30 years, which mutual fund managers are, they trot it out in every single forum, is highly misleading. That 15 years is not every year. It is very lumpy. It is very bunched up. 2 years of solid gains, and then you have like 2-3 years of very tepid, in fact, negative returns. And then again, it goes back up. And really speaking, for most investors, they don't have the stomach for this kind of wild ride. So I can appreciate their real concerns.
What will it take for markets to turn? And I'm just want to extend on this question, Shankar, for the benefit of our viewers. Markets bottomed out at the peak of COVID crisis when the first vaccine was also not discovered, and that's largely because valuations had become that attractive. So we are not there yet in terms of a fire sale. So valuations are not particularly attractive. So what will take the market to turn? Will it be crude? Will it be Fed? Will it be war?
I think the only way this market turns itself around is, first of all, you have to give it time. So it's like an illness. As I gave the example of a medical problem, there are things that will take time. If you have a sprain or a fracture or even a migraine, there's not much you can do. You have no real fast forward button you can hit and suddenly become cured. You have to, convalesce in a decent place, and hopefully you will come out of it, provided you've done the right things. So you have to give it time. We've just kind of gotten into this funky situation in the stock market. I don't think you can just simply say that it'll get over by next month. It will take some time. And that time, in that period, a few things need to change. Obviously, commodity prices really need to cool off a lot. Inflation headline prints have to moderate, which, the prints have just started worsening. So for them to start to moderate on a year-on-year or sequential or, quarterly basis or half-yearly basis, the next print must be like, comparable to the previous 6-month print, which means we have to linearly go a few months down the road for the data to just look optically better, because this data, has to be compared with 6 months down data. And therefore, time is really critical here. We need to sit this one out. To expect that this gets over very quickly is probably not a wise, or at least not a sensible, line of thinking. That said, in this period, as I said, you will get the fundamentals and foundations of the next bull market for sure. From now until the next, maybe the end of the year also, you will find stocks which are not falling. You will find stocks which are delivering numbers. You will find stocks that are really beating the market. In this period itself, you will build a portfolio for the next 5 years. And that is really what most investors should be looking at. Instead of fretting over the losses, start thinking constructively that where can I recover these losses? And you may not be able to recover it from your existing portfolio.
There are two ways to approach that. Shankar, buy something from the rubble. For example, IT has corrected, pharma has corrected, consumer tech has corrected. That's the bombed out space where the disregard for valuations were there, but now they've corrected. That's option number one. Option number two, let's look at price action. The markets are rotating, which is an ITC is coming back, a NTPC has come back, Coal India has done phenomenally well. What is Shankar Sharma, the investor, doing? And how is Shankar Sharma, the trader, hunting?
So I don't trade anymore, unfortunately. I was telling my friends that, had I been the old guy that I was, I would have, that there was enough to tell us from middle of last year itself that, there was a problem building up in the markets. But, I don't have the, let's say, the wherewithal in me to be as aggressive a trader as I used to be 10, 15 years back. And I don't even need to be. I've gotten old, let's put it this way. So I'm not trading. But on the investment side, obviously, we are all losing money. If that's any comfort to people watching the program, we will all get hit. There is no way you're going to get into a boxing ring and you are the only guy throwing punches. You will get punches thrown at you. You will have to take them because that's what this game is about. You'll have to not get knocked out. You'll have to bob and weave and survive 12 rounds because this is not an easy fight. Uh, the market will come around, as I said. My strategy is to really look for strength. That's exactly what I'm doing pre this call, post this call, every single day. Where are pockets of strength in the market? And then I will wait out a quarter for the numbers to, because it might be just a technical strength for some time. It may not be lasting. I will get confirmation from the bunch of quarterlies that we have seen. We will see that in July also when the June numbers come out. And then I will start to add those names and get out of names which are, down and out and probably not coming back in the next bull market.
Like an HDFC Bank qualify as a stock which was a hero, but now we must respect it has turned. How would you classify that stock?
Turned as it is classified turn, meaning turn for the worse?
Turn for the worse, because the price action is not very conducive or very appealing.
That's true for pretty much all the private sector banks, Nikunj, with the possible exception of ICICI Bank. I think almost all of them, if I'm not mistaken, Axis Bank itself has done nothing for, I think, 4 years. You can probably see the chart. 4 or 5 years, I think the stock is more or less, medium or even negative returns. HDFC Bank, similar 2.5 years, I think, negative returns. Kotak Bank, flatline, probably negative now for 2.5 years or 2 years. RBL Bank, less said the better. So the whole private sector bank place is absolutely, I've been unequivocal, not a place to be in for the last 2.5 years. If anything, they're a lot worse now because, all of them drove their numbers through consumer lending. And when inflation is a problem, people don't want to go out and borrow at high interest rates, for sure. You might think that 100 rupee on EMI doesn't matter, but then you are not representative. The real Bharat is very sensitive to paying up more for financing costs or even just spending in an era where there is so much inflation. So discretionary spending will be definitely hit. And these guys who are funding discretionary spending, I think this is not a good space to be in at all.
Should one start thinking slightly contra, which is that, look, inflation ultimately is a numeric number. 6-8 months, the base effect would kick in, which is next 6 months bear the pain of inflation. But in this market crash, by commodity consumers rather than producers, because when everybody is, it's a global united effort by politicians that we have to bring inflation down.
Yeah, so, killing inflation is obviously the primary purpose why central banks exist. It is not to foster growth. If you look at, the charters, mandates for all central banks, it is exactly that, which is price stability. And to that end, obviously, the Western central banks have a tool which does affect affect inflation by curbing demand. Okay, it does, that because those economies are very highly leveraged in terms of the consumer spending, credit card debt, all that. We know the numbers are significant, and therefore by tweaking rates, you do bring down consumption, which then brings down, uh, you know, sort of your growth and thereby inflation. In India now, that's a different problem altogether because I'm firmly of the view that the RBI has no control over inflation at all. It has control over growth, and by raising rates, you kill growth, but you do not kill inflation. You look at your inflation basket, there is hardly anything which is sensitive to interest rates. Hardly anything. Your fruits and vegetables, whatever. That's like our pulses. 40-50% of the basket in CPI is that. That's not going to be sensitive to rates. And the rest is, of course, a lot of supply side constraints and stuff like that, imported inflation through crude and other commodities. There's very little RBI can do by tweaking rates. They have done under pressure, in my view. It is not advisable, but they had to do something that to show that they are acting. To answer your question, what you should be buying, you should buy things which have some degree of pricing power. I don't think you have a lot of companies falling into that category because even the branded FMCG companies, we all know that they have been cutting back on the grammage because they cannot pass the price hikes. They're reducing the pack sizes, which means that they are really speaking, struggling to pass on headline price index, increases. In this environment, you mentioned ITC and people, will smoke a bit. Maybe that's the place to hide if you want to hide. I don't think you're going to make 30, 40, 50% on that, but maybe it doesn't fall because the names you mentioned did not rally at all. They did not participate. So obviously those names will do better in a bear market. It's the high flyers which actually take the beating, which is exactly the kind of market we are in.
What is your definition of strength? Can you identify what to your mind is the pocket of strength?
I can tell you the rules. I will not tell you which ones, but the rules are simple that start looking for stocks or groups which from the time the market started to correct or fall, have held up well. Okay, so that is the first. And then start looking at the numbers to see whether the quarterly numbers match that price action. Because remember, just price action is never good enough. Price action can happen because of a variety of reasons, which is why most traders lose money. They have no idea about the fundamentals underlying the price action. I at least look at price action, I marry it with fundamentals because that way my strike rate goes up. Instead of being a 10-20% strike rate, I shoot to make 50-55%, 60% strike rates. And beyond that, you cannot get it right anyway, so forget it. So if you look at groups that did not fall or stocks that did not fall much, stocks that actually went up in this period, you have a good selection already. And then please go down through the screeners, look at the fundamentals to see whether they exhibited any sales growth, margin stability, margin increase. All those metrics, there are not that many, there are only 10, 15 metrics that you need to follow. You will get a pretty decent group of companies, Nikunj. This is not rocket science. Anybody can do it.
What happens to small cap investing in this kind of a market? Because that's where the price dislocation would be very high. Now, you may see in this market when price dislocation is high that the stock you want to buy has become very cheap. But price action is not with you. Would you be a contra buyer if you like a small cap stock if it is checking all your boxes?
No. So I don't like, as I said, that I like usually to buy strength with fundamentals. I don't like to buy weakness. If a stock I liked has become excessively weak, meaning it has fallen 50, 70, 80%, I'm not interested in buying it. Okay, absolutely not. Because decent stocks don't fall 80%. If they have fallen, maybe there is an underlying fundamental problem. So price action can tell us that there is an inherent problem also. Therefore, I will wait. I will go and check the quarterly numbers. I'll talk to management to see what is fundamentally broken that your price has fallen by 50, 70, 80%. So, I will not go and buy weakness at all. That's not in my model of investing.
Shankar Sharma also has been sometimes a contra investor. You bought chemicals, you bought commodities. I remember when nobody wanted to buy Tata Steel, there was a time when Tata Steel did pop up on your radar. Is it time to perhaps start thinking contra, let's say in the bombed out consumer tech space or even bombed out pharma space?
So pharma had a bit of a place under the sun, when the COVID problem happened. But pharma is a fairly mature trade. There is nothing very exciting there if you think holistically. It had been obviously a problematic situation because of the problems around Sun Pharma and all that. So that industry is not going to give you major gainers. In the middle, the API trade came, which all of us played, made a bit of money, but ultimately it's a commodity business. And you can see where all the stocks have gone. They have really, really, cracked. So pharma is not something which is very likable at all. Consumer tech, I'm not sure which names you mentioned. You mean when you mention that you're talking the new age listings, then obviously I've been clear that the listings were great from a capital market perspective, in which they got capital instead of going to the US, they got capital locally, which is fantastic because it gives investors more options, rightly or wrongly, but at least options are there. So that was a great thing for the maturity of this capital market. It was a great thing for the VCs, a great thing for the investment bankers, a great thing for the founders of those companies, but terrible for the investors. But I have no sympathy for investors who piled into these stocks, giving easy exits to VCs. And I have no sympathy if you're going out there and buying these stocks just because they've fallen 50%, because they are reverse compounders. They will fall 50, then they will fall 50 again, they will fall 50 again, and then they will fall 50 again, till they hit a level of maybe 90% lower than where they IPO'd at, or maybe after the IPO, if they did go up, then they will still fall between 80 and 90%, most of them. So there's no rush to go out and buy those either.
Since you put your pictures out on Twitter, I saw your pictures that you are with your friends, and I can recognize Amit Bhartia, a common friend at Como. Now, you're working from Como, you're joining us from an hotel room. I was hoping that you would be in Bellagio at George Clooney's residence, enjoying a cup of, if not malt, maybe a wine and some tiramisu.
No, I got back. Yeah, this was a few days ago, and we had a lot of fun there. Just us boys. Obviously trying to make a last minute party to enjoy whatever is remaining of our wealth. So as I said, that that is paper wealth that needs to be converted to real wealth, and the real wealth is when you hang out with friends in a nice place like Como. So yeah, that was it. And yeah, we had fun. We went to Bellagio. We did go and have a glass of wine sitting over the water.
Como is famous for a lot of other things, Shankar. We shall talk about it once this camera interview is over.
Oh, absolutely.
Appreciate it. I'm so glad that you could join us.
Thank you, Nikhil. Thank you for having me.